In the realm of trading, knowing the right terminology can not only enhance your skills, but also make you more appealing on a date. If you're looking to impress someone special, diving into the world of Forex might just do the trick. Here's a comprehensive guide to essential Forex terms that will elevate your conversations and your trading prowess. Understanding the distinction between major and minor currencies is fundamental in Forex trading. Major currencies refer to the most traded currencies globally, usually from countries with robust and stable economies. These currencies include USD, EUR, JPY, GBP, CHF, CAD, NZD, and AUD. These currencies are characterized by high liquidity and are widely accepted, making them the sexiest options for traders. In contrast, minor currencies originate from smaller or emerging market economies. While still traded in significant volumes, they lack the liquidity of major currencies. These currencies often come from developing nations and typically exhibit less stable market conditions. Exotic currencies are even less liquid and can be more volatile, usually from less developed economies. Trading in exotic currencies involves higher risks and spreads, making it essential to tread carefully. When you start trading, you'll encounter two primary types of currencies in every currency pair: the base currency and the quote currency. The base currency is the first currency in a pair, serving as a reference for the transaction. For instance, in the USD-CHF pair, the USD is the base currency. If the rate is 1.6350, it means 1 USD equals 1.6350 Swiss francs. The quote currency, on the other hand, is the second currency in the pair. This is often referred to as the pip currency, as any unrealized profit or loss is expressed in this currency. One of the most crucial concepts in Forex trading is the pip. A pip is the smallest unit of price movement in the Forex market. For most currency pairs, a pip is represented by the fourth decimal place. For example, in the EUR-USD pair, a movement from 1.2538 to 1.2539 signifies a 1 pip increase. However, some brokers provide quotes to a fifth decimal place, introducing the concept of the pipette. A pipette is essentially 1/10 of a pip, allowing for more precise measurements in price movements. This can be especially beneficial for high-frequency trading strategies, where small price fluctuations can impact profitability significantly. Understanding the bid price and ask price is essential for executing trades effectively. The bid price is the price at which the market is willing to buy a currency pair. It appears on the left side of the quote. For example, in the GBP-USD quote of 1.88215, the bid price is 1.882, meaning you can sell 1 British pound for 1.882 US dollars. The ask price is the price at which the market is prepared to sell a currency pair. In the same GBP-USD quote, the ask price is 1.885, indicating that you can buy 1 British pound for 1.8815 US dollars. The spread refers to the difference between the bid and ask prices. This is crucial to know as it represents the transaction cost for traders. In the earlier example of GBP-USD 1.8.215, the spread is 3 pips. The tighter the spread, the more favorable it is for traders, as it indicates lower costs. The quote convention is the standard format for expressing exchange rates. For instance, in the EUR-USD pair quoted as 1.2345, 1.2347. Base currency, EUR, quote, currency, USD, bid price, 1.2345, ask price, 1.2347, spread, 0.002. This standardized format simplifies the trading process and helps traders make informed decisions quickly. The spread acts as the transaction cost for round-turn trades, which involves buying and then selling the same currency pair. For example, if the EUR-USD rate is 1.28215, the transaction cost would be 3 pips. A cross-currency refers to any currency pair that does not include the US dollar. These pairs can behave erratically since they effectively initiate 2 USD trades, often leading to higher transaction costs. When entering the Forex market, it's crucial to understand margin and leverage. Margin is the amount of money a trader must deposit with a broker to open a position. This varies between brokers, ranging from as low as $100 to $100,000. The amount set aside as the initial margin requirement depends on the currency pair, its current price, and the number of lots traded. For instance, if you have a mini account with 200.1 leverage, opening a mini lot only requires $50 from your account. Leverage allows you to control large amounts with a relatively small investment. Different brokers offer varying leverage ratios from 2:1 to as high as 500.1. While leverage can amplify profits, it also increases risk, making it essential to use it wisely. Arming yourself with this Forex lingo not only boosts your trading confidence, but can also captivate your date's attention. Discussing concepts like major and minor currencies, pips, and the intricacies of bid-ask spreads can showcase your intelligence and enthusiasm for learning. Consider starting your conversation with something like, "Did you know that the EUR-USD pair is one of the most traded in the Forex market?" It's fascinating how the bid-ask spread can affect a trader's profitability. Such insights can spark engaging discussions and demonstrate your depth of knowledge in a subject that might intrigue your date. Mastering Forex terminology can be a game changer, not only for your trading success, but also for your social interactions. By familiarizing yourself with the essential lingo, you'll be well equipped to impress your date and navigate the Forex market like a pro. For even more insights and real-time updates, consider joining our